So one of the things with this generation that's also investing and struggling with this level of interest rates is the level of interest rates that they grew up with, especially when they were coming out of college, going into the workforce, initially trying to buy a home, having kids, and be a consumer, is that the level of interest rates was so high. As we mentioned, if you were in the early 80s, it was 20%, that they mentally feel that these rates are ridiculous. Don't worry about it. The rates are going to go back up. And that's just not necessarily true. First of all, they've been very low now and declining ever since 2008 and with the financial crisis that we had. So do the math, that's 12 years already. And you can go back and look throughout history, when the manufacturing started to decline in Japan and go off into other areas in Southeast Asia, and they were left with huge excess capacity, their interest rates dropped dramatically. The economy went into a major recession, and everybody thought, they'll be back in 2 or 3 years. Well, that's now been about 35 years, and they're still struggling, and probably will never get back to where they were. So we have to bear in mind that the interest rates and all the dynamics for interest rates staying low are going to stay probably low for a long period of time. And also bear in mind that as much as I like bonds, we manage several $1 billion worth of bonds. If interest rates do start rising at some point, well, now you're fighting a headwind because as rates go up, the price of bonds go down. It's an inverse relationship. So be careful what you wish for, because you're much better off to be investing in bonds when rates are high and declining than low and stable or low and rising. So when you begin to look at alternatives, and I mentioned I manage several $1 billion worth of bonds, so don't get me wrong, I like bonds. And bonds have a place. But right now, the place of bonds generally with the rates as low as they are for security. They're just not going to be where they're providing extensive total returns. So look, you've got to have a certain amount in bonds if you're approaching retirement. You don't want to be all stocks. As we've seen recently and throughout history, it's a dangerous world out there. Stuff happens. And when stuff happens, the market is going to react to it, and you don't want to be in the wrong place at the wrong time, so you certainly want to have a balanced portfolio. But that doesn't eliminate the need for income. People still need to live, and portfolios have to generate certain amounts of money, hopefully without attaching principal, for people to survive. So the reality is right now, and again, we've been an income manager focused on income for over a half century that we've been in business. And so we've been through a lot of different cycles, and you have to learn to adapt. And even though we manage a lot of bonds, we manage a lot of other types of equity solutions, without a doubt right now, the best solution for people that are preparing for retirement, people that are in retirement, is really high dividend stocks. I mean, the stocks, at least from our perspective, different people may be different, but we're right now paying about 3.6% from dividends, and it's been very, very consistent, over the last 15 years, and then generating total returns that are very, very strong and into low double-digit territory, depending upon the time period. And if you want more information about that, then we'll be happy to provide you with information showing that distinctly. But suffice to say that when you look at a high dividend portfolio, you're really striving for an 8 to 10% total return, and then hoping to get 3.5 to 4% from income. Well, I think anybody in this environment, if they said, if I could reasonably target an 8 to 10% return, then they would probably be happy with that. So let's say, for the sake of the math, you say, boy, I'd really like to have a 10% return. Well, if you're getting almost 4% from dividends, you're starting on the 40-yard line. So every year you start off and already have 35, 40% of your goal. If you're happy with 8%, you already have 50% of your goal. And so you've dramatically increased the certainty of reaching your total return. The other thing that happens is that, bear in mind, this is not a stagnant environment. So dividends are being increased every year. So we're buying companies that not only are paying a high rate of return, currently 3.6% in yield, but ones that are increasing dividends every year. And on average, those dividends are increasing 8 to 10% a year. So most people, when they were working, certainly weren't in a position to where they were getting an 8 to 10% raise every year. And what we're doing is that in those portfolios, they're generating, in essence, what's an 8 to 10% raise or increase in cash flow every year, regardless of what the up and down cycle is in the market and in pricing. So that's a very, very big component, because the math's pretty simple. If you're going up 10% a year, about 3 years out, because it's compounded, you're up about 36, 37% in higher income. So if you could sit there and say, well, 3 years out, I'm making 35, 40% higher income, that's not a bad place to be, regardless of what the market's going to do. And so that increase in income is a very, very important component. So when you look at these types of portfolios, the current yield is very important. Increase in yield is very important, because guess what? Cost of living has gone up. You want to be in a position that where very few investments are, where it's actually increasing the income every year. And then obviously the final component is we're trying to have total return. And in essence, we're really just trying to buy big, very conservative stocks, companies that they're growing earnings 6 to 8% a year. And if I can get my dividend, my increasing dividend, if I can buy the stocks right and just track the earnings increases, I don't even need any PE multiple expansion. All I have to do is track earnings. Well, guess what that adds up to? You got 3.5%, 4% for dividends. You track earnings at 6 to 8%. Over the long term, you can reasonably target a 10% type of return. And now you have a strong return with inflation hedge. You have high current income and income that's increasing. And that's what we do with our staff of almost 70 people, is to try to find those ideas, single point good ideas, good stocks that achieve that, and then also make sure that all those stocks marry together properly in the portfolio to control risk, to be able to meet your objectives.